Hey guys, this is another quick video which I wanted to show. I shared this with my graduate class and I wanted to share this with the undergraduate class as well. But I'll be a lot faster, I'll not go into as much detail. So one way to look at the balance sheet, as you've learned in your accounting class, is to have assets and liabilities on either side. And the assets can be thought of as fixed, current, intangible, and then other financial assets. So this part you might or might not have seen. So there are certain firms which do invest in other firms. One example which comes to mind is the Microsoft investment in Facebook, much early on before Facebook's initial public offering. So Microsoft invested $150 million in Facebook in about 2009, and that investment grew a lot. And firms can also make investments in various other firms. Another example, a very, very good example, is the Chinese firm Tencent. So Tencent invests in a lot of firms, including JD.com and PDD. And those are also included in the assets of the firm and not on a separate balance sheet. Okay. The liabilities remain the same. Another good way to try and think about a firm's balance sheet is to think about the firm's balance sheet as existing investments versus other growth assets in some sense. So existing investments are investments which do generate cash flows today. So these include long-lived assets and short-lived assets. Okay, so these are the assets in place. So think of a semiconductor manufacturing company, such as like Intel or AMD. So existing Intel 9 or Intel 11 or the AMD Ryzen cash flows. So all the money which those investments have made, they are in the balance sheet and they generate a profit today, and they will be generating the profit for the foreseeable future. But there are certain other new technologies which AMD is investing in, and new potential chips which do not generate any asset, but the research and development which goes into creating that asset will create value in the future. And the growth rate created, so those kind of assets can be thought of as growth assets. So a lot of technology firms have a lot of growth assets. There's a lot of defensive firms, something like Walmart or Costco. They have a lot of existing assets and assets in place. For a company like Walmart or Costco, the growth assets are the new stores which they have not created, or Walmart's new online store which can grow, which they can expand to various countries. So those would be the new growth assets for Walmart and Costco. And their assets in place are all their existing stores. Okay. Another way to try and think of firms in some sense is to try and think about the life cycle of a firm. Various firms are in various stages. The stage one is the startup phase, and then firms can go into some sort of young growth phase, and then if they're successful, if they do not get bankrupt or bought out by that stage, they could go into a very high growth phase, and then eventually to a mature growth, and then some sort of stable industry, and then finally they might go into some sort of declining industry. So Target and Walmart are much more in the later stages, whereas certain young technology firms like TikTok, for example, are probably in the young growth and the high growth phases over here. So Facebook used to be in these sort of stages, and they're probably between high growth or mature growth, and then maybe they're nearing mature stable. The difficulty is to try and figure out which phase a particular firm is. When a firm has gone all through the cycle and they've kind of declined and they're dead or they've sold off all their assets, it's very easy to look in hindsight and figure out where the firm was at various points in time. But for an existing firm, it's very difficult, whether it's a temporary dip or if it's a permanent decline. So these are things which you need to think about when you're analyzing a firm. And remember the big picture for any financial operation. The main decisions which come to finance, which we'll be learning throughout the course, is the investment decision. This 3310 MOS course focuses a lot on the investment decision. The financing and the dividend decision might be left to a little bit of a later stage. But investment decision, if you want to boil it down to the very, very basics, you have to invest in projects which give you more return than the cost of the investment. That's the very, very basic common sense investment decision in some sense. And the return you get should reflect both the magnitude and the timing of the cash flows. So you cannot make an investment where most of the money will be returned to the shareholder or the investor 10 years from now. This sometimes might be too risky for various investors. Okay, so the return cannot be very, very low for such a different kind of a cash flow. The later decisions will involve maximizing, having the optimal mix of debt and equity and the right kind of debt, and how much money should you return to your shareholders. But these are questions which you will be learning in an advanced finance class and not in the introductory class. For this particular class, the main goal of business, or for any financial manager or the CEO or the CFO of the firm, will be to maximize the value of the business of the firm. And most of those decisions are related to the investment decision. If you try and think about on a survey, what finance functions are most important to firm value, a lot of them think about managing debt, managing strategic decisions, risk management. These are what the CFOs have replied to. If you ask the CEO, the analysis might be a little bit different. It might be a lot more focused on the investment decision, whereas the CFOs manage a lot more of the financing and the dividend and other decisions. That is it for this additional quick video. I hope you all like it. All right, I'll see you all next week.